What if the smartest move isn't moving at all? Right now, thousands of homeowners are feeling stuck. They've outgrown their home, want upgrades, need more space, or simply want a better lifestyle, but they also don't want to give up the incredibly low mortgage rate they locked in years ago. And honestly, who can blame them? So instead of packing boxes, paying moving costs, and restarting life somewhere else, many homeowners are discovering something surprising. Their dream home might already be the one they live in. This week on Mortgage Minute, I'm breaking down why HELOC demand is surging across the country and how homeowners are using the equity they already have to renovate, upgrade, expand, and transform the homes they already love. But there's a right way and a very wrong way to use home equity. And before you make any major housing decision, you should understand both. On today's Mortgage Minute, I am going to share several strategies on how to have the best of both worlds.
Points up here. I want to talk about millions of homeowners are sitting on record equity, and America now have trillions in tappable equity. What does that all mean, Art?
Well, tappable equity basically is the concept where you're going to look at the value of homes in terms of the overall, on an aggregate basis, what's the value of residential homes in the country? And then you combine that with what is the aggregate balance of mortgages secured by those homes. And of course, the difference is what? Your equity. And what we're seeing is, despite the fact that home prices in recent times have moderated some, overall, what we're seeing is that gap between the aggregate value of the U.S. residential housing stock versus the aggregate value of the mortgage debt secured by that stock, it's growing. And it's in the trillions with a T.
That's wild.
And so when you consider that, despite everything we just said about we're hopeful that maybe we can get a breakthrough and then the housing market could get a real shot in the arm and oil prices come back down, inflation moderates, and the bond market settles down, and maybe mortgage rates start to settle down as well. Don't forget, it was only 3 to 4 months ago, conforming conventional loans were under 6, and we were offering like 5 5/8, 5 3/4, and things were pretty good, but it still had not unleashed that segment of the housing stock of homeowners with these 2 to 3% mortgages. And so we still have to consider the fact that even with some improvement that may be coming, those folks really have a decision to make about what to do. And that's why this headline on this slide is so important. A lot of them don't realize they are sitting on a financial tool. And so what I want to get into is what is their alternative? Because there are other ways to achieve what they want to going forward, because their current housing they may feel may not be meeting their needs. But that doesn't necessarily mean they've got to bite the bullet, give up 2.5% and take 6% and buy another house. They don't have to do that.
Well, isn't that one of those mindsets? I mean, I've been married for 29 years and I've seen it where we have equity and we're thinking shouldn't we go buy another house? We have all this equity in our house. And that's why I like the topic of today. There's a smarter way to do this. It's like, hey, we bought our forever home, but now it's not forever because we have this equity. And there's almost this yin and yang going on there, or really it's a tug of war. Talk to us about that a little bit.
Well, see, and that's a conversation a lot of families, a lot of couples are talking about. There's that yin and yang, like you said. Well, the sort of the knee-jerk thought is always when your home gets to a point where you don't feel like it's meeting your needs, well, you think the solution, the only strategy is, well, you got to bite the bullet, sell it, and look for something that is better suited for your needs. And I think some of those homeowners who've been kind of on the fence, stuck in that position for now a pretty good amount of time, because gee whiz, think about it. The pandemic was, gosh, what's 5-6 years ago now. Well, what they don't realize is their forever home may be the home they already own.
Yeah.
But so how do you get from, it doesn't work for us anymore, but we want to get to a forever home, and we think we have to sell to find that forever home, when in reality, we can provide them a way to achieve that forever home without having to move at all. So that's really what I think we've got to get folks to focus on, because right now they don't realize they may already be in a situation where they don't have to move at all and yet achieve their goals and get things more in the forever home category that they are yearning for. And so that's really what we want to get into. And like this next slide shows, why don't people want to move right now? You know, you think about, they may be chomping at the bit that the home they have now just doesn't satisfy them like it should, like they want it to. But yet they are hesitant to move, they're hesitant to sell it and move. And of course, what's the probably the most obvious reason? Because of where rates are right now. I mean, if you're at 2.5%, and you know, if you're watching the financial news and they're giving you the weekly Freddie Mac rate survey, because it comes out every week, and you know, the most recent number that we talked about last week, it was 6.46. So you go, wait a minute, I'm at 2.5. Why in the world would I sell my house, even if I have a ton of equity, and give up 2.5 and go to 646? That doesn't compute. So they don't want to do it. But there's other reasons too, right? I mean, you can get into the whole, just the concept of the sales process. Anybody who sold a home, not just sold a home or bought a home, but particularly for you homeowners with that low rate, if you've ever sold a home before, it can be darn stressful. Especially, you know, in some markets, and we see it out here in the Coachella Valley. I mean, some realtors are moaning and groaning about the fact they've got listings, they're holding open houses, and they're not seeing a whole lot of buyers come through. And a lot of buyers who are coming through aren't like just chomping at the bit, look at the house and write an offer. And so that can become very stressful if you're a homeowner and you're anxious to sell, and it just isn't happening quickly enough. And we see that in the days on market, because now it's not 22 days or less than 30 days. Now it's more like 50 to 60 or more in most markets. Another thing that they have to worry about is, I don't know about a lot of homeowners. I think this is for some of them, just the whole concept of packing and moving. I tell you what, I hate moving. I've never liked moving. And now I'll admit, in the past years when I have moved, a lot of times I try to take that on myself. I've learned you should never do that. Hire a professional, pay the extra money, and you can hire a mover who will not just move you, but they'll pack everything for you and move you. It'll cost you more, but it's worth it. But nonetheless, that's stressful. And then of course you've got to deal with, if you do put your house on the market, what if you do get some offers and there's competing offers, and then you got to figure out which one to take. And then you're into the whole negotiating game. And some folks just don't like to deal with that. It's just a turnoff for them. So, and then the other kind of subtle thing you don't think about is, if you sell your home, again, you're willing to give up that 2.5 rate, and you're willing to take current rates. Of course, we can help you with that, buy downs and so forth to keep that rate low. There is a little sneaky expense factor in that process. When you buy that next home, presumably it's going to be a higher price, right? What's going to happen? Your property taxes are going to be higher than what you're paying now. You know, right now, if you've got a home, Prop 13 is a California property tax rule. Your property taxes are going to remain relatively stable. They're not going to go up by more than 2% a year at most. So that's sort of a hidden cost of, you know, selling, moving, and buying another more expensive home, is you're going to have an increase in your property tax rate. So when you consider all those other reasons besides just the high rate, you put it all together. That's why we still have too many homeowners not willing to list and sell and move on.
Yeah, you know, just a real quick, real story, because my wife and I, again, because we had the equity and we're thinking this was before we did something that made it our forever home again. And we started looking, we said, hey, we have all this equity and we can go buy a house and pay cash because we have this equity, but that means we're downsizing. We have to now compromise. It's not getting something bigger, better. It's getting something smaller. And then, like you said, even though we're getting something smaller, we're paying more, and our taxes went up. It was just like, okay, those were things that said, okay, I'm not moving. I'm not selling my house. And of course, you know, we've been guilty, meaning those of us with gray hair, you know, we've been guilty of being said, hey, you're the problem because you're not selling your house because you got the low rates. but that's because we've done the math, we've done those other things. So I'm just curious, what's our other alternative here, Art?
Right. Well, the other alternative is, and it's as a slide shows, there's a better way. So if you're a homeowner in that situation, what is the better way? Well, it's a HELOC, or I think more broadly, I should say, an equity loan, because of course that takes various forms. But the point is, HELOC has become sort of the generic term for an equity loan. Everyone seems to know what a HELOC is. It's a pretty well-known concept these days. Of course, for those who don't know, HELOC is an acronym for Home Equity Line of Credit. But the point of it is really the better way when you're that homeowner facing all those challenges I just described, where you're trying to merge together the desire to improve your housing, but at the same time you just don't want to give up that very low rate, and you don't want to deal with all the other stress factors involved in selling and moving and starting over. And so as a consequence, that's why this is can be in a lot of instances a better way. And of course, the most important thing is with this HELOC, or an equity loan in general, it allows you to keep that ultra low first mortgage rate that you got probably during the pandemic, either when you first bought your house, or if you already owned your house before the pandemic occurred, you refinanced into that very low rate, because refinance activity in 20 and 21 was off the charts. So that's really what's going on here, is that you're allowed to keep that ultra low rate. And by the way, another subtle point about keeping that low rate, and I can't argue with it, it's actually smart thinking financially. Consider how when your rate is at 2.5 versus if you sell and buy another and you're now at 6 or 6.5. Consider that 2.5 rate, what does it do for you in terms of wealth creation? Well, because the interest rate is lower, a bigger portion of your payment is being applied toward principal, not interest. So if you give up that 2.5, and let's say you've had that loan for 3, 5, 10 years. Of course, if it was 10 years, you're not at 2.5, you're probably at 3 7/8 or 4. But let's say in particular, last 5 years, if you give up that 2.5 and you start over at 6, and you're probably going to have a bigger loan than you have now. And because it's at 6, not 2.5, the amount of interest, that the interest segment of your total payment's a lot higher, and you're going to be building equity more slowly than what you're already building with your existing home. So that's a subtle point that I think folks don't pay attention to.
Well, one of the things that it says, you have a lot of options when you go this route. And so the question is, what are they using HELOCs for, Art?
Well, there's a variety of things. Let me give you a kind of a list of things that should be considered. And again, as the slide shows, instead of starting somewhere else, go ahead and consider redesigning what you already have. And give you some examples. Kitchen remodels, ADUs, pool renovations, as you put up there, multi-generational housing. I mean, when you start to look at this list, you go, well, wait a minute, we can achieve a lot of the things we're trying to get, home gyms, entertainment spaces. So these are all improvements to your existing home that you might be striving for because they don't have these features now. So are you better off giving up that low rate, going through the stress of listing and selling and packing and moving and starting over, and you're going to be probably paying more for the home than what your current home is worth. You may not have as much equity with the new home as you currently have. You can achieve some of these, features in your existing home so that you then eliminate all the stress of moving and packing and all that. You still get to keep that 2.5%, 3% first mortgage. So you're still more, rapidly paying down that part of your mortgage debt. So these are the kind of things that folks, I think, need to think more about as an alternative to just giving up that low rate and moving and starting over. So those are the kind of things that we're seeing people are realizing they can use a HELOC or an equity loan in general to achieve. So then they suddenly go, well, wait a minute. Now I'm addressing my lifestyle needs. If it's a growing family situation, I'm adding more space. Chances are, in most cases, people are living in a location, an area that they enjoy. They don't really want to be uprooted. They may have friends and, their kids are in school and they don't want to uproot the kids from school. And so when you start thinking about the benefits of this, as we call it, hidden lifestyle upgrade, you suddenly realize, yeah, that might be a better approach. I can create what I want that I think is elsewhere. Grass is greener on the other side. Wait a minute, I can create the lifestyle that I want with what I have already. It's sort of a foundation I can build on. And then once we've achieved that, we don't have to move our sphere of influence, or our friends. Our kids are in the schools that they want to be in. Certainly, if your kids are getting older and getting past elementary school and into junior high and high school, man, oh man, the thought of them moving when they're going into that part of their, education life can be really traumatic for them.
They could hate you forever for that.
Well, yeah, they can sometimes. And so this is why the equity lending, segment of the industry, I think, is really starting to just take off. And by the way, we've gotten quite a few equity loan applications here just recently, last few weeks. So I think homeowners are starting to realize this, and we're seeing evidence of that with what we're originating right now.
Well, I just have a question because, you helped us, my wife and I, about a year ago. It's been just right at a year ago. We took this move because we had that 2.75 or 2.5%, I think is what it was, interest rate. And so when we decided not to sell and move on, even though we had a lot of equity, you helped us see the opportunity. And now my wife re-loves the house because we redid the whole kitchen. It doesn't even look the same. And that's really what she was looking for. Every time she looked at a new house, it was like, oh, look at this kitchen. I got more room. Now she has that. But my question is, by us doing that, or anyone else watching doing that, doesn't that also push the value of your current home up when you do a bathroom or kitchen or those type of things? Like we repainted the house and put a new roof on it, put solar, all that stuff in that remodel. Doesn't that push the price or the value of the home up as well?
Well, yeah, many of them do. I mean, when you get into home improvement, remodeling, or adding on, obviously one of the things you have to focus on is what things are you contemplating doing in terms of, upgrading your home to achieve your lifestyle goals. I think the thing you want to think about is you want to approach that not emotionally, but strategically. And you need to understand that whatever improvements you want to pursue to improve your lifestyle and to improve the ability of your existing home to meet your needs, I think you've got to be wise and strategic about how you use the money. And so when you look at the variety of things that you can use the money for, some of them absolutely are going to pay off in terms of value. Again, kitchens are probably the number one thing I hear all the time. And you're right, Jeff, when it comes to a married couple, almost always the hubby, doesn't matter what they think. It's all about what the wife wants. And when it comes to a kitchen, the wife almost always is going to be the boss, and that's the person you've got to satisfy. But the point is, a good kitchen remodel is absolutely going to pay back in terms of return on value. Same with bathrooms, ADUs certainly. Adding, if you're limited on bedrooms, and maybe you bought the home when you were younger, married couple, no kids, and now you got a couple of kids, adding a bedroom, maybe two. Absolutely, that's going to add value because number of rooms, bedrooms, bathrooms absolutely are key comparable factors in terms of how homes are appraised. Office additions, if you're an older homeowner, what we call aging in place upgrades. Now, there's other things you can use it for, but those are the kind of things that are going to add value. Yes, solar for sure, especially if it's outright owned solar. Now, new roof, you could say, well, may or may not add to your market value of your home, but you know where it's going to help you? your insurance costs.
Mm.
You got to think of that. If you've got a 30, 40, 50-year-old roof, insurance companies now, they focus on how old's your roof. And if your roof is too old, you may not even be able to get insurance. Whereas if you get a new roof, that you got to let your insurance company know right away, because that's probably going to help with your insurance premiums. And again, that's not direct value added to the price of the home, but it's certainly going to help you overall in terms of the expense of owning the home.
Well, the other thing is it also with we have a flat roof, a lot of flat roofs out here in Southern California in the desert, is we went with that foam roof. So now we have a white roof. It has extra insulation. So I think we're going to see some reduction. This is our first year in the summer. We're going to see some reduction in our overall heating and cooling costs, I think.
Exactly right, because you're right. The newer roofs that are offered and made are put on homes now, I think they're a lot better in terms of things like insulation factors. You can get the underlying underlayment, they call it. You can get underlayment where it's going to directly help you in terms of keeping the home cooler on the interior, which of course is going to help with your power bill. And of course, if you get own solar on top of that, man, oh man, you're off to the races in terms of your utility costs. So why wouldn't you do that? And so, yeah, when it comes to HELOC, again, the kitchens, the bathrooms, adding another room, adding an office, adding solar, putting on a new roof, those are all strategically wise things to use the money on. Now you can use it for other things like, paying off debt, maybe pulling out some money to give to your now adult child to help them with a down payment so they can get off the couch and go buy their own home. Those can be smart things too. They're not adding value, although maybe the emotional value to help with your adult child go buy their own home and enjoy their life, and then you can visit them from time to time. But the point is, those can be very effective uses for this type of option, the equity lending, the HELOCs. But you got to be wise about it, because in some of these uses, you've got to be careful, because again, as it points it out there, you've got to be smart. You got to use it strategically, because there are some things to consider, especially on the HELOC side, to make sure it's the type of product. And as the next slide shows, HELOCs are not free money. You do have to realize it's new debt, and there are some factors you need to consider. It's a variable rate loan. The HELOC is typically tied to the prime rate. It's going to have a margin added to the prime rate. Right now, the prime rate is 6.75. And if you're really good credit score and you have low equity, even after getting the equity line, or after after getting the equity line, you could get a margin over prime that could be zero. That's why you can get some of these HELOCs that we can offer. You can actually get them in the sixes, which is the same rate as a new first mortgage. And so, but it is a variable rate loan. So you have to consider the fact that over time, the rate on that HELOC could change. Now that's both higher and lower. So it's always going to go up, but you need to keep that in mind. You also need to understand, be careful about over borrowing. If you're going to get an equity loan, especially if it's a HELOC, you want to be careful about, ascertaining how much money do you really need for whatever improvements you want to make. If it's debt to pay off, how much you need to pay off debt. If it's money you want to pull out, again, to give to a adult child to help them with down payment so they can move. So you've got to make sure you're using it for the right purposes. And one of the things I worry about sometimes, and I've done a few HELOCs where I end up finding out that the homeowner may be thinking about using the money for what I would call some lifestyle choices, as it comes up. You want to be careful about, don't go out and borrow money on a HELOC or an equity loan and then take that money and you're going to go on a 3-week European vacation. You've got to be a little bit careful about that, and a little bit, again, strategic and wise about it. And where that's particularly true is, we get HELOC requests and we arrange them where folks are paying off debt, in particular revolving credit card debt. Whenever I'm in that situation, I'm gladly going to help that homeowner and get rid of that debt. But at some point in the process, I'm going to have a direct, frank discussion about, you've got to change your behavior. If you're going to use a big chunk of your equity loan, your HELOC, for paying off revolving debt, you've got to change your behavior, because the worst thing you can do, and I saw this happening 20 plus years ago before the Great Recession of 2008. We had some cases where homeowners were taking out a HELOC, paying off debt, and then 6 months later, a year later, they come back and they have to do it again. You've got to change that behavior. You cannot use a HELOC or an equity loan, pay off I've had cases where it's $100,000 of credit card debt.
Wow.
They'll take that HELOC and they'll pay it all off. And the effect financially is very good. They're going to drastically lower their monthly payment cost and even their interest rate cost. 22% versus 6.5%, 7.5% is a big win. But it's not going to continue to be a big win if a year later that $100,000 credit card debt is back because you used your credit cards for all that lifestyle spending and the 3-week European vacations, buying that $75,000 car. Where it doesn't make sense. So you got to be very careful about that. So you need to understand what you're getting the money for, what your strategy is to use the money, and then be persistent and focused on making sure you follow through in that strategy and don't get off the rails and start spending that money in frivolous ways. Because again, it's not free money. You're incurring debt. You've got an interest cost, and you can't let that escape your mind. You got to realize that's part of the equation, and you have to manage that very well.
Well, I have to jump in here and say, because as I mentioned before, you helped my wife and I with our situation last year about the same time. And you were very careful about this whole overborrowing thing. Like, we had a lot of equity in our home, but I think now combined, we're probably in about a 55%, maybe 60% tops loan to value. So we still have equity left over, which, as you said, allowed us to get a little better rate, but we didn't overborrow.
Right.
And that was a huge thing. And no, we did not go on a luxurious, I think we went to Eloy, Arizona, and we drove. But no, that was huge because it's easy. It's almost like, I'm going into the ice cream store and I'm going to get all those. No, you were very good about helping guide us and to say, hey, let's do it strategically. What are you trying to do? This is what we got. So it was, if you're thinking about this, make sure if it's not Art, it's somebody like Art, which there's nobody else like Art, to do this, because it's easy to say, I've got all this equity. Let me take as much as I can. I just think that's, as you were saying, that could be a mistake.
Well, it can be, but in terms of a HELOC, the other factor that people think about and why they get asked for them is they can, in some cases, want to, they may have all these other uses that we've just talked about that are wise and they can be strategic, but sometimes they may also want it just to have a rainy day fund, to have access to cash when they need it, more of an emergency situation. And that's a fine strategy, as long as you're disciplined about realizing that that's what it's there for. And then you don't fall to the temptation of going, oh, I want to go do this little lifestyle thing or that. And then you realize, oh, I'll just take it out of my HELOC. Because one of the things I tell people about HELOCs, think of it as a credit card. It's basically behaves like a credit card, except it's secured by your house. And so the problem with that is some folks might start using it as a credit card. We all know that how many folks out there have too much credit card debt because they're using it to pay for things that are not an asset, that aren't going to build value. It's just lifestyle expenditures that eventually gets away from you. And then you go, oh, great, I had a lot of fun with all that money, but now the day of reckoning is here and I'm not sure I know how to pay it back. We need to avoid that. You need to avoid that.
Well, the last one is, what's next, Art? What are the next steps? If somebody's listening to this and they say, well, this sounds pretty good. I didn't really want to move. And now thinking it through, maybe a new kitchen and a new bathroom or whatever it may be, like us with kind of a remodel of the house with paint and roof and whatnot. What's next?
Well, what I would suggest is contact me. And what we'll do is we'll have basically, I'll call it a sit down, although in most cases, we don't tend to meet people in person, although I'm happy to do it. I offer that all the time. But the point is, what's really good is get a conversation started. I'm going to essentially interview the homeowner. I'm going to be collecting sort of some facts about their situation, their financial position currently, why they're interested in this type of loan, what they intend to use it for. And I'm a pretty good sounding board. I've been around a long time. I've had a lot of experience. I've dealt with a lot of different homeowners, a lot of different personalities, and a lot of different objectives that all homeowners have. And so with that, part of that process, I'm also going to determine what kind of equity they have available. And so with that information, I can then start presenting them some specific tangible equity loan options where I'm going to present to them terms and conditions. I'm kind of famous for providing folks worksheets because I've talked about in the show before. Too many people talk to a mortgage lender and they're looking to get a mortgage and they never find out what the price is when they start the process. Mm-hmm. I don't believe in that. Once I gather enough information from you, I'm going to be able to give you a pretty highly accurate worksheet with all the numbers so you know the price before you start. And if we do that, then I think I can lead you down the right path to achieve all these objectives and goals we just talked about, and do so in a wise and safe way, and in a way that's going to help you long term, both improve your lifestyle, but maintain your objectives in terms of your financial objectives, building wealth, and still maintaining some equity. And over time, I think you're going to have the best of both worlds. You're suddenly going to realize you've got a home that you don't have to get rid of. You can convert it into your forever home. It's going to then meet your lifestyle. It's going to do so in an effective way, in a financially manageable way. And that way, I think you're going to be a lot happier in the future if we can have that conversation. So